first, we start with the Fed committing to remain all in. Jay Powell and company wrapping up their final meeting of the year. The central bank signaling rates will remain near zero for a very, very, very long time. But they did up their economic outlook slightly for next year. So, Brian Kelly, all in. What do you do with this information?
Yeah, that's the question, right? So, I mean, we've known they've been all in for a long time. And so that's probably why we didn't really get that much of a market reaction from today's news. The next step for the Fed that we have to worry about, and we have to think forward about this, is what's going to happen if the economy does pick up. So if we get this consumption boom, the vaccine works, everybody gets inoculated, and then we get a consumption boom. Everybody wants to go out to dinner again and fly and travel and all of these things. Does that increase inflation? And then what does the Fed do? The Fed's committed for several years to keep interest rates low. So they may have inflation raised higher. Let's call inflation at 4%. They may have to peg interest rates at 2%, but you would still get this negative real yield, which we've talked about before, which would be very positive for assets, including stocks.
Yep. And Guy, I think that this really is underscored by the Fed's tweak in the language in the statement. That sort of conundrum. What does it do if inflation, if the economy really picks up? Because instead of saying for a long time, so a time-based goal of how long they're going to stay at zero, it's now an outcome-based goal. They talked about until substantial further progress has been made toward maximum employment and price stability goals. So if this is achieved quicker, you got to wonder, what does the Fed do at that point?
I don't think they know the answer to that question. I'm not trying to be glib. I really don't think they know the answer. And this comes down to, Melissa, it's be careful what you wish for, because it's pretty clear, I think, to everybody that they're hoping that they start to see an uptick in inflation. And obviously, Steve Leisman could probably speak to this. But, you know, they want it in a slow and just sort of stair-step way. I don't think that's what's going to happen. I think when it comes, and I think it's here already, it's going to come in a wave, and I don't think they're going to be able to control it. And I don't think they know what to do on the backside of that. So, look, I've been concerned about their insertion into the markets for quite some time. Clearly, the equity markets haven't cared. Maybe I shouldn't care either. But, you know, getting to a point now to Brian's the points that he just made, where next year is going to be fascinating if all these things come to fruition. And by the way, those are all the things that we want to happen. But again, be careful what you wish for.
Should we start worrying about that, Dan, in your view, at this point in the depths of the pandemic? When we're seeing, you know, perhaps the economy take a leg lower in the month of December as we do see some more lockdowns and restrictions go into place. Do we worry about things getting so hot that the Fed needs to step back from zero?
I don't think just yet. And I think you make a really good point, Mel. I think the next couple of months we're going to see economic activity that really is going to make a lot of skeptics think that we're headed towards a double dip recession. Obviously, there's a lot of optimism built into the stock market about the vaccine and about when our population is going to hit herd immunity. But I suspect that's going to be take a little bit longer than a lot of people think, right? And so when you think about where interest rates are and the dovishness of the Fed, we know that they're going to stay very accommodative. We also know that whatever passes this year or in the next few weeks as far as fiscal stimulus is really not going to be enough to bridge small businesses and some of our most vulnerable citizens over the course of the next few months, where this virus is raging across the country and causing all those mitigation attempts. And bringing it back to the stock market, I mean, come on. In 2019, there was no earnings growth year over year for the S&P 500, and it went up 30%. In 2020, earnings are likely to be down 15%, and it's up almost 15%. So at some point, something's got to give, and I think Guy kind of nailed it. Careful what you wish for by wishing rates so much lower, because what did they do up today? The 10-year yield, it ticked up a little bit here. So, you know, any upward volatility on rates is going to be really bad for the stock market near term.
What is the message to the markets in your view, Tim, after this afternoon?
First of all, the statement was a non-event. All right, let's be clear. I think the sense that markets have surprised to their resilience, it's almost a Fed pat on the back, obviously. And on some level, look, we've been all somewhat critical of the Fed, some of us more than others. But what the Fed had to do and step in, the Fed was aggressive, and they were more aggressive once again than policymakers. So I think the message is that we are going to do what it takes. We have the toolbox, et cetera. If anything, yes, that's the symmetry dynamic of inflation means they can overshoot. We've been hearing that for 2 years. What I'm concerned about is an asset bubble, especially in housing. And that's one of these things. In fact, we had Peter Booker on last week, who writes great stuff, and he talked about the absurdity of the Fed in buying the mortgage-backed market. I agree. The absurdity of the Fed also just buying high-grade corporates. So these are the things to worry about. 2018, if you remember, was the year that central banks around the world tried to take liquidity out of the market, and it was a disaster. And it ended in one of the worst Decembers the markets have ever had in DEC 2018. So we just have to be very careful. What we have right now is artificial in terms of the market's support system. At some point, that will be taken away, but I don't see that happening anytime soon. And I'm not running for the door.
Yeah, and we didn't get much clarity on asset purchases and the changes that could potentially happen in the future, whether it be moving towards the longer end of the curve or scaling back MBS. Let's bring in Steve Leisman for more. He's been following this all. You were on that nice Zoom call with all your fellow Fed reporters. Steve, what stood out to you this afternoon?
You know, I don't agree with a lot of what's been said here for a couple of reasons, if I could just throw down the gauntlet a little bit. First of all, I think you're judging the chairman's pain wrong. I don't think he's worried about what happens when this economy accelerates. He's very keenly focused on the next 4 or 5 months, if you ask me. And he's keenly worried about what's going to happen with the economy. And you can't have one part of the discussion about what happens when we take off without having the first part of the discussion about where we are when we take off. If you think about the trajectory, and I guess I'm just sort of imitating the picture up there for Powell, but if you think about it, we could be down here or we could be up here. And we could be going like this or we could be going like that. And that really depends on how we get over here. And it's very important to think about what the damage is that's going to happen to the economy over the next 4 or 5 months. The other thing is, I'll just take on my good friend and musical colleague, Mr. Seymour here. I don't think it was a nothing statement because the Federal Reserve actually took quite a monumental act, I would say, in pegging asset purchases to the same goals as interest rates, which are the idea that it's going to be linking it to achieving maximum employment and price stability. We didn't ever have that guidance before. That tells you, I think, the Fed is going to be involved in asset purchase for quite a long time further. I think that's pretty bullish for the market. I think there is going to be a time when they're going to have that discussion about bringing down those asset purchases. But the Fed, first of all, gave us guidance on that, which it had really not done ever before, linked it to interest rates, and sort of told us it's going to be happening for a while. It
was guidance, although some people are wringing their hands because substantial further progress is still ambiguous in some respects, Steve, although I think that the consensus is still that it's going to be there with $120 billion worth of asset purchases per month for the foreseeable future.
I think that's right. And we will be having a discussion, which, was mentioned at the top of the show, of the idea that we're going to be bringing that number down over time, especially if the economy does do better than expected. I think that'll be the first thing to go. And I think there's a reason, by the way, why they separated. They said 80 billion and 40 billion of mortgage, 80 billion treasuries, 40 billion, because I think that mortgage number may be the mark to come down probably first. They'll do it, I think, in a measured way. I think what happened, Melissa, is the Fed took out a piece of paper and wrote on the top guidance for asset purchases and then put 2 things in there. But there's a lot of blank space, I think you're right, on the guidance that is to come. I think they'll be filling that in over time.
Hey, Steve, so yes, there's cold rain and snow out there, both literally and in the markets. But you talk about the Fed that has now pegged interest rates to purchases. Isn't this circular? The Fed totally, at least, is pinning the long end of the bond market, too, aren't they? And so I first of all, totally respect, and you give some great insight into the nuances of Fed policy here. And I don't think any of us are suggesting that the economy is strong. But the interest rate dynamic doesn't seem any different to me than yesterday, when I think they control at least the long end of the curve for now.
I think you're right about that, Tim. And I think if they don't actually control it spot on, then they can control it if they want. They held in abeyance this idea of lengthening the duration of their portfolio to the extent that they could go in and sell short, buy long, push down or flatten the curve, or even cause it to invert if they wanted to. I don't think they want to do that now. I think, again, Powell's been playing a bit of a waiting game on fiscal policy. I think he's waiting to see what they come up with. If this $900 billion dollar package does pass, it's going to take a little pressure off of him to kind of wait and see. He can say, I have my pedal to the metal here. Now Congress is doing their thing. I think if the talks on stimulus or relief had fallen apart, we'd be having a different conversation about what the Fed had done today.
Steve, always great to speak with you. Thank you.
Pleasure.
Steve Leisman.
Shepard Smith here. Thanks for watching CNBC on YouTube.